Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast connecting you to the world of investing and helping you stay ahead. Today we check in with Director of Quantitative Market Strategy, Denise Chisholm, for her sector watch analysis and what recent data is telling us about the broader economy. As the markets find its footing after last week's global sell-off, Denise shares if this was part of a healthy market correction or if it's a sign that a recession or even possible hard landing is on its way. She says looking at historical data, what you will find is that when there are big spikes in the VIX, especially relative to the increase in credit spreads, which run up but not very much, what you will find is that in the top 2% of all occurrences, even in the top decile, those spikes tend to happen 85% of the time outside of recessions. So for Denise, the recent sell-off was not a typical recessionary signal. Yes, a shock to the market, but based on history, not shocking enough to tip the market into a recession. Denise says the labor market continues to be strong with the participation rate increasing, especially those at prime age between 25 and 54 years old. In terms of strong sectors, Denise says financials and healthcare are showing potential to outperform. Denise says it may be time to lean into those economically sensitive sectors. This podcast was recorded on August 8th, 2024.
So you could say that today, now, because everything's hindsight, maybe the market's overreacted a bit to the labor story, and maybe it's not as bad as we thought, but we didn't know that yesterday or the day before. What do you think?
No, we didn't know that in the last week, it seems, or at least the market didn't. Look, I think that there is increasing concern about the labor market, and we have seen, now a peak to trough decline of almost 10% in the S&P 500, more in the NASDAQ. So the question always has to be, as an equity market investor, is this a normal and healthy correction, which always has an impetus? There's always something you are worried about in normal and healthy corrections, right? Because they happen in most years. Or is this the sign of something more ominous? Aside from the Labor Department, or aside from the labor issues that we'll highlight in a second, you've heard me talk about the fact that what I like to do most during corrections is to look at the internal signals of the market. Right. They can usually point us in the right way. And this was a very, very unique sell-off, which I'm sure most investors out there know why. You do not often see a spike in the VIX occur with that magnitude or with 50. That ferociousness. Exactly. I think it was actually 60 intraday and we're back down to 24. Yeah. So this was, it was a very interesting dynamic. And the question is, does this dynamic have any informational content? And for me, when I look at the historical data, it in fact does. The interesting part, while we're concerned with, is this the beginning of the hard landing that we have all been so fearful of since 2022, what you will find is the big spikes in the VIX, especially relative to the increase in credit spreads, which went up, but not very much. Yeah. What you find is we're in the top 2% of all occurrences, but even in the top decile, those spikes tend to happen 85% of the time outside recessions. So this is not a typical recessionary signal in the internals of the market that I'm saying.
But it's interesting as a shock, right? And you'll talk about shocks that have caused all kinds of different historically recessions and so on. What sort of shock? I guess this does not fit into the category of shocks that will really rock the market longer term.
Yes, no. In some ways, when I think about shocks and what tips the economy into recession, historically speaking, they come from one or two places. One, the Fed, interest rate payments spiking, meaning sort of taxing on the consumer, and two, crude oil. Those are usually the relevant shocks to either, you can kind of call the 2000 recession a net worth shock when stocks went down in an egregious method, went down in an egregious way. I analyzed tariffs in a shock like that, but they were really minuscule. So when you see shocks, when I talk about shocks, it's really like a tax on the consumer. Yeah. And this is not that. This is more like a financial thing, a market thing. Maybe you can compare it to things like in the late 90s, like the Thai crisis or the Russian default. We obviously saw a lot of movement in the yen around sort of the tide going out on people or investors who maybe didn't expect Japan to hike and the Fed to cut it quite the same time. So that lack of expectation can cause a financial event. But that is very different than a recessionary event, which recessionary events cause I'm going to call it a permanent impairment of capital, in the sense that it usually takes you 2.5 to 3 years to get the money back that you lost during recessions. We historically don't see that in any other non-recessionary market corrections, and that's why you get the buy the dip math.
Okay, that's obviously exactly where we're going, because it was V-shaped. I mean, we're bouncing with V's here, not rounded lowercase w's. Yeah.
Most bottoms actually are V's.
Yeah, I guess, but it was a sharp one. So to what extent have we dispelled, and it could all change tomorrow, it seems, but dispelled the idea that, okay, the labor market is really in trouble. The Fed needs to do intra-meeting cuts, and for sure September is going to be 75 basis points. Is that kind of in the rearview mirror, or?
Well, if it's not, it probably should be based on the data the way I see it. So okay. I understand the narrative in the market. We bottomed at 3.4% unemployment. We increased to 4.1%, and then we just increased another 0.2% to 4.3%. This looks like it's getting unruly. So there's an interesting math behind what we actually saw in the increase in the unemployment rate. Remember, payroll growth, while it slowed a little bit more than it has in the past, is still positive in the payroll survey and in the household survey. So people are continually being employed. At the same time, you are seeing a rise in the unemployment rate. That means mathematically, it's actually being supply driven. So this is not typical, right? So most of the time, 65% of the time, when the unemployment rate is rising and you are going into a recession, the labor force participation is declining, not increasing. So what typically happens in a recession, again, if you're looking at all the data and saying, okay, is this something that we typically see? Should this put us on watch? This is very atypical. Usually as you go into a recession, and I mean even the year prior, what you find is labor force participation goes down when people say, forget it.
Yeah.
I can't find a job. I'm out of the labor force. We are not only not seeing that, but we actually just saw a spike in the prime age, so 25 to 54, labor force participation rate to the extent that we have not seen over the course of the last 2 years. And it's finally higher than it was in the financial crisis. So we've taken this long to get our labor force basically growing again. So this is unique, right? So again, most of the time this doesn't happen, and certainly doesn't happen in recessions. So if you look at that scrape of data and say, okay, we are a supply-driven increase in the unemployment rate, how often does this happen in recessions? Actually, only about half the time. We have non-recessionary parallels in the 90s and in the 60s. And when this has happened in the past, the market hasn't had a problem with it. The market hasn't had a problem with it and has returned, 15 to 20 percentage points, double your historical average. So there is definitely, data can always change, but right now, supply-driven increases in the unemployment rate look a lot more, to me, like a renormalization of the labor force than an ominous recessionary signal.
So I had never heard of Claudia Sahm until you mentioned her months ago, and now we must read about her, 40 times a day. So what do we do with her rule? Because her rule says actually we are heading into something more sinister.
Yes, so she just actually was on Bloomberg. I was reading it this morning saying, hey, look, wait a minute. It's my rule, so I get to determine what I say about my rule. She's like, I think it is different this time. And she's picking up on the same dynamics in terms of supply. I think that we all think that it should cause the Fed to rethink their restrictive stance on monetary policy. So she has highlighted that. Taylor of the Taylor rule has highlighted that. But there's a difference between saying that, like, wait a minute, maybe you're too restrictive, relative to what inflation may come down the pike over the next year, versus saying this is a foregone conclusion that we're in or about to be in a recession. And I think her point is, this is not a foregone conclusion. The reason I created the rule was to give the Fed a sort of like bell ringing, like, wait a minute, now you don't have as many issues as you think. The reason why the Fed uses the unemployment rate even more so than payrolls is because, again, they have the dual mandate, right? So full employment is obviously one, which if the unemployment rate is increasing, that's you are moving away from full employment, but it doesn't necessarily mean employment is going to contract. But what's most important about the labor market dynamics is for their other mandate, which is inflation. The Fed, and we can debate whether or not it's right or wrong, but the Fed, most on the Federal Reserve Board, believe that sticky inflation comes from the labor markets. So if there is more supply relative to demand, wage prices will not end up higher for longer, which means the Federal Reserve has less of a sticky inflation problem. Right. So in my mind, Claudia Sahm, she didn't say this, but if she were to say additionally, what this means is that, look, guys, there is no inflation in the labor market right now. So you do not need to be at 200 basis points of real rates.
Right. You're not fighting it. You don't need to be fighting it. You are
Correct.
fighting it, but you don't need to be fighting it ultimately.
You already fought it.
You already, right. You already fought it. It's done now. You can drop it.
Right.
Let's move into some of the sectors and actually caps, just a different cap size. You wrote this great piece about a week ago looking at small caps. Small caps had an extraordinary July. There's no question, in anticipation of really the interest rate story. You dig in further and say it's really not just an interest rate story, and you give it, put more flesh on the bones for why small caps were doing what they were doing and ultimately where they go longer. But they're having a rough go right now. It's been a bit of a chuck it out. So what do we think about small caps now that we're in August?
Yeah, it was like all in, small caps, Fed's going to cut, and then completely out, right? So we reversed almost all of the rally from a short-term perspective. So again, sort of stepping back, is this an opportunity, or is this something that would tell you that there's a negative risk reward? I look at the data and see an opportunity. And the opportunity that exists is around those labor market signals. So remember, small caps are rate sensitive, very true, but they are rate and growth sensitive. If you've heard me talk about the Fed, it's not about the Fed cutting. It's about why the Fed is cutting. Right. So that's why small caps gave back almost all, or depending on where we are today, almost all of the rally. Because if the Fed is cutting because we are headed into a recession, that has not been a great time for small caps.
Not a soft landing, which is what they were.
Correct. That is not a soft landing. What you want in terms of 70% odds, or the sweet spot for small caps outperforming large caps, are for the Federal Reserve to be cutting, or interest rates to be going down, and earnings growth to be continually accelerating. Now, that doesn't happen in recessions. So whenever you get this knee-jerk reaction of, oh, wait a minute, are we going to have a hard landing? I would not necessarily expect small caps to be leadership in that microcosm. So then the question becomes, is this new correction an opportunity? And I think around those labor market signals that we were just talking about, if the hard landing, once you look at the labor market data, is not really evident, and if the base case is that earnings will continue to accelerate, and oh, by the way, off of these profitability levels, it's very rare, or increasingly rare, to see a contraction in payrolls. That creates this positive risk reward backdrop, just from a backdrop perspective, for small caps, on top of the fact that you highlighted. I mean, it's this stretched rubber band. You have relative valuation on your side, you have interest rate cuts on your side, you have wide valuation spreads on your side. I think that this all leads to a very unique setup that is a positive risk reward.
And you add into your note here that actually looking, so all those pieces, and so assuming that all of that is beneficial for small caps and for that story, and that's the backdrop, you actually say the most consistent impact is actually the multiple story.
Yes.
And then that is also relative, because it's looking at sort of relative to, say, how high larger caps might jump in an interest rate environment that is easing. Yeah.
Yes. So I think that that's the unique part. So I've read a lot of notes when small caps were rallying, right, which was like that 10% in 5 days or whatever it was. A lot of strategists came out around the fact and said, well, look, we're not seeing any signs of positive earnings growth. This is all multiple expansion. So if it's just multiple expansion without earnings growth, this is not really a positive trajectory. And I actually think that that is exactly the positive trajectory that we should be prepared for as investors. Because the way interest rates work on small cap stocks is not, at least statistically, via earnings growth. I know the narrative is if the Fed cuts rates and small caps are uniquely predisposed to floating rate debt, all of a sudden they have less debt service to pay, so they have more earnings that they have that investors should be interested in. That might be true, but you can't show it statistically. It happens half the time, and half the time it doesn't happen. But what happens the vast majority of the time, and by vast majority, I mean 80 to 90%, what you see is that relative multiple expansion. So when interest rates come down, the stock market more disproportionately rewards small caps over large caps. So it's not a change in fundamentals. No. It's a change in the way the market views future fundamentals. And that's why I think it can be a pain trade, because I don't expect a whole lot to change. There's not going to be a situation where all of a sudden, instead of 40% of your small cap index being unprofitable, it's going to go to 20 because the Fed cut rates. We're not going to see that change in trajectory. But because multiples are so stretched, interest rates might have a disproportionate effect. So if you just back test the math, what you find is, on average, since 2000, when you are at the stretched relative valuation and the Fed is cutting interest rates, you can get a relative multiple appreciation of 20 percentage points. And again, this is an average, so there's a wide dispersion around that. But imagine if I said you will get no multiple expansion, but now all of a sudden you will get 20% earnings growth. Well, all investors would be interested at that. But in some ways, the way I look at it, it's the same math.
It doesn't matter. It still goes up. Yeah, it doesn't. I mean, it doesn't really matter what's true. So, so would you say then? Try to nail you to the wall on this. You don't. Feel free not to be. But did investors just get a second go at small caps?
I think so. No, that is definitely my base case. That's what I've been talking about internally. But I will say, look, it's tough to get investors when the markets are this volatile. Instead of getting people to easily lean in, okay, now Denise, I buy it, it's more likely that you get people to lean out. It's actually harder to get people into the story because it seems like there's now a real problem.
There's a risk.
So it is always, yes. Although there are always risks, right? So it's the market. That's the unfortunate part about the market. But yes, so I think you got essentially a second bite at the apple, meaning that you didn't miss it. But it is always the trick. So when stocks are going down, you don't want to buy them. And sometimes when stocks are going up or up by a lot, you don't want to chase. So it is very complicated to get either investors or, retail or institutional off the sidelines into something that's either underperformed or down.
Are institutional off the sidelines vis-a-vis small caps?
They are increasingly buying them, which is interesting, and you can see it in the flow data. In fact, the flow data showed one of the biggest inflows in history that I have. I think the data goes back to the mid-90s. So it's not that robust of a data set, or to me, because I like data back to the 60s. But it is, it's an interesting sort of chase. And there is a lot of data around, well, if it's retail, some people call retail, well, maybe not so smart money, meaning that if retail is buying, maybe you want to be selling. And that's actually not true historically. But institutions, it's actually the opposite. Right. If there's a statistic behind it, it's almost like that they tend to be smart money, meaning that institutions actually have big inflows into an asset class, specifically down the cap spectrum, that tends to have momentum in terms of a trade. So it is more often a positive indicator than the opposite. So that inflow that we saw, we'll see if it gets reversed, that inflow that we saw after the big up move in small caps is a positive signal in my work.
Any views on the amount of leverage in markets today, given the yen carry trade unwind? How much more to go to an extent? But what do you think?
So it's a great question, because in some ways this really, when I look at the data, was less about the labor markets than it was more about what happened in Japan.
Yeah, totally.
And to me, Pamela, we were just talking about this before the show, but I think that this is a very unique time. Most times when the Federal Reserve hikes, people get sort of off sides, and it can tend to be problematic for some currency markets and even potentially for the bond market. Usually by the point at which the Federal Reserve is cutting, it's well articulated and discounted in the vast majority of the market, so it's not a surprise. But that does not look to be the case this cycle. I mean, it is very true in the bond market, in the sense that if you use Fed fund futures or the yield curve as to saying, well, who in the bond market doesn't know that they're actually going to cut rates? But I think that the currency markets weren't set up for that, nor is the equity market. When you look at, equity sensitive sectors or interest rate sensitive sectors, you'll find that most of the time before the Federal Reserve cuts rates, they actually have outperformed by about 1,000 basis points. Our equity sectors that are geared towards interest rates have underperformed by that, which is what you typically see before a hike. So it is almost that currency investors and equity market investors were positioned for this higher is longer.
Yeah.
The Federal Reserve is not going to be able to cut rates. And this was a very caught offsides trade, right? You don't often see Japan down 12% overnight. You often don't see what happened in the yen happen all that often, right? They're very infrequent, but very, very financially driven, to your point. It is very much a carry trade, which is, so Goldman and Morgan, I think, both put out pretty good mathematical pieces on the bulk of the carry trade unwind is probably over. Yeah. They disagree between like the exact percentage. I want to say it was between 60 and 75, but the bulk is probably over. And I think that this gets back to the increase in volatility, maybe as a result of algorithms that we've seen over the course of the last decade, where trades get unwound very quickly.
Very
so
quickly.
It almost becomes very like correcting.
Yeah, self-correcting.
Yeah.
So I mean,
self-correcting.
What do you think of the whole idea of us being very used to forward guidance? Like, we don't think they're going to do anything until they tell us. That's what they're
right.
And then others who maybe just didn't pay attention. I mean, one of the arguments is the Bank of Japan had led some hints that, this might become, it's just maybe the majority of us weren't listening. I don't know. I don't know if that's true or not, but it kind of goes to that idea of, we're pretty stewed and baked in forward guidance, and maybe we just can't handle it when other banks do things that we didn't expect.
It's problematic because I think that there is the forward guidance of what we're going to do next, 25 basis points. That part might have been embraced by the markets, but I think it was the hawkish rhetoric around it, how durable that 25 basis points or like whisper numbers of what is to come in the future, that's the part that I think markets can get shaken up about. Because, and we saw this coming out of our own post the financial recession when they hiked interest rates for the first time. It did not go easily or smoothly in the markets. And now you think about Japan being in the exact position, but for a much longer duration. So it's not the move that matters, the 25 basis points. It's the terminal rate that I think that the market is debating. How many hikes for the Bank of Japan and how many cuts for the Federal Reserve? And that's what's being debated in markets, not what they're going to do next meeting.
Question about thoughts on the amount of cash on the sidelines and the recent pullback. And is there money on the sidelines that could go back in? But what do you think about cash on the sidelines?
Yes, there has been a significant amount of cash on the sidelines this entire time, I would say. When you rebase it in terms of market cap, it doesn't look quite as egregious. So if I just showed you like the cash numbers on the sidelines, you'd be like, whoa, that's crazy. We've never seen this before. When you rebase it and normalize it, it doesn't look quite as extreme. But there is certainly cash on the sidelines for what I would call a potential continuation of the pain trade higher. So that's the ability of the market to climb the wall of worry, which is that cash on the sidelines. And that's why it's so tricky. So recessions or, big downdrafts in the equity market very rarely happen when everybody has a knee-jerk reaction to, should we be concerned? It usually happens at the point when you say, nah, it's not going to happen. There's no risk to that. We've just lived through X amount of years. It's fine. That's usually typically when markets get caught offside. And we're certainly not there. When you look at cash on the sidelines or just the sentiment, the reset, how quickly sentiment resets is a definitive thing that makes this cycle very, very different from other cycles. And I think that that's tied to cash on the sidelines. People get nervous quicker.
But it was a buy the dip. This week, last week, right now.
Right. I think it still is. I think it's still a positive risk reward.
Tell us a little bit about the cyclical sector story that you're watching right now. And I don't even know if the whole story is cyclical, but we're about to go through an easing cycle, it looks like, unless something very drastic happens. How do we stack up in terms of sectors?
Yes, so I will say, we just had this debate internally in our market meeting. I can show you data that says, hey, look, if you look at the Federal Reserve and you say every time they've cut, you will find that on average, defensive sectors outperform, like utilities, like healthcare, like consumer staples. So that is true, one, depending on how much time you use, especially true over the last 15 years. Because when the Federal Reserve has been cutting over the last 15 years, we have had an economy that has been in trouble.
Right.
So it goes back to that why, so when you look at a longer period of data going back to the 60s, you'll see that the Fed has been able to recalibrate monetary policy. And I'm going to call them what we used to call the mid-cycle slowdowns in the mid-90s, and the mid-80s, and the mid-70s, and in the mid-60s.
That sounds so historic. Yeah.
I know, right? But forever
anymore.
ago, we haven't had any mid-cycle slowdowns because we didn't really have a recovery post the financial crisis, not in the same way because they couldn't hike interest rates.
Right.
So we are a little bit out of date. So look, there will be strategists who you read that say, if the Fed's cutting, you want to get defensive in your portfolio. And those numbers are true. The issue is when you look at all of the data, it's A, less true, and B, when you look back historically, those sectors like utilities, consumer staples, and healthcare were in a situation where they were accelerating in terms of operating margins. They were uniquely profitable with unique pricing power. Now you have the exact opposite side of the equation.
Pricing power is coming down.
Right, that's exactly right. So, I mean, we've seen a little bit of a bounce in consumer staples over the last, let's call it 3 to 6 months. But after the worst 18-month degradation in margins on record that I have going back to the 1960s. So your defensive sectors changed. They changed a lot in terms of fundamentals. And I think that those fundamentals are more important in the rock, paper, scissors playbook of what matters relative to what the Fed is doing. So especially true if earnings growth continues to accelerate, that defensive posture is still a negative risk reward. So I think that the pop that we've seen in terms of utilities outperforming, healthcare outperforming, consumer staples outperforming is something that you actually want to bet against continuing as an investor and lean into those economically sensitive sectors. These are not all like, you wouldn't call them cyclicals. I still like financials and real estate the most from an interest rate sensitive perspective.
Okay.
Those are the ones I'm like still gravitating towards because I feel like they have a confluence of mathematical signals that I really think that suggest there is potential, 2x upside risk in those relative to the downside risk because valuation spreads are so wide and valuation is still so supportive.
That is absolutely fascinating. And there must be a little bit of a relative story in there for real estate anyway.
Yes. So there are a lot of relative stories in there for real estate. I mean, one is just on relative free cash flow in terms of valuation. And this isn't always the way that real estate investors think about how to invest in real estate. But based on my data on relative cash flows, they're actually at some of the cheapest levels that I have going back in history. And again, it's not 100%. But the cheaper they are, the more likely they have been to outperform. And that's despite fundamentals being at or near troughs. So that usually bolsters your case for a positive risk reward. They also work, again, you saw them sort of be a quasi defense when interest rates are going down, despite concern in the overall economy, where financials are a little bit more geared towards if there is going to be a contraction in payrolls, financials are a little bit more levered to that trade than real estate actually is. But I think both are two sides to a very similar coin statistically on this wide valuation spreads, which in my mind is an expression of fear, and really strong valuation support on indicators that have mattered.
Your research just slices through so many preconceived thoughts and analysis. Thank you, Denise Chisholm, for joining us and bringing it all to us.
You're always welcome.
Great to see you.
Great to be here.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. While visiting fidelity.ca, you can also find information on future live webcasts. And don't forget to follow Fidelity Canada on Twitter and LinkedIn. Thanks again. See you next time. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada, ULC, or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.